Welcome to Inside Economics. I'm Mark Zandi, the chief economist of Moody's Analytics, and I'm joined by my two trusty co-hosts, Cris Durides. Cris is the deputy chief economist, and Marisa DiNatale. Marisa keeps the trains on the tracks. So good to have you both. How are you guys doing?
Hey, Mark. Good. How are you?
Doing well. Everything's okay. You guys are back up and running. I know you were under the weather there for a little bit, but you're feeling better. You kicked COVID.
I'm back at 100%.
Okay.
Marisa?
I wouldn't say I'm 100%. I'm still not feeling great. I'm a little congested, as you can probably hear, but
No, you sound good to me.
Oh, good. Okay, good.
Yeah, and you look marvelous.
I have my Kleenex at the ready.
Okay, perfect. Good.
It's early morning for you, though. So
that's true. That's true.
Very early. Yeah, thanks for doing this so early.
Yeah. Where you're traveling, Mark?
No, I was in New York for a couple of days. I made it back home last night, and I was at a Moody's credit risk conference. Boy, what a lugubrious bunch of folks. So I do this informal survey, and I say, who out there thinks that we're going to have a recession in the next 12 to 18 months? Raise your hand. 100 people in that room, I'd say 95 think we're going into recession in the next 12 to 18 months. But these are all risk managers. I mean, so maybe a little bit more pessimistic.
They're paid to be more pessimistic.
Yeah, I think so. But it made me very nervous. That group. Yeah, I tried to cheer them up, but no, impossible.
It's tough. That's tough.
Yeah, it wasn't going to work. And we've got a guest, John Tuig. Good to have you, John.
Welcome. No, I think the number of Google searches for lugubrious just went up. That was for a 7:30 word vomit on me there, Mark. That's a strong one. I wasn't ready for that. So
I've got these Zandyisms, and that's
kind
of on the list. Lugubrious.
Okay.
Yeah.
Oh, Mark loves his words.
I love my words.
Man, that was a strong one right out of the gate. So good morning, everybody.
Hopefully I used it right.
Have your Webster dictionary in your coffee for this particular presentation today.
Or Chat GPT.
Absolutely. There you go.
Yeah.
Maybe this all just is Chat GPT. Maybe it's not really us. Maybe it's just bots.
Could be.
There you go. Yeah.
And the listener can quickly discern that we have a good relationship with John.
Absolutely.
Yeah. John is at Raymond James. And John, I don't even know, what's your title? Like
managing director, head of whole loan trading here at Raymond James.
That's a great title.
Thank you.
Yeah, and we've been doing these. Would you call them webinars? Are they
webinars, podcasts? I mean, if you remember when COVID happened and everything in person kind of went away, we all pivoted to online media, right? So when we didn't know what Zoom was, when we were still trying to figure out how to use our webcam, and everything had gone from audio to video. So I don't know, what is it? Is it a podcast? Is it a vid? Is it a VOD? Yes, the answer is online content. And we are, to your point, you just did your conference here the other day. I just got back from Atlanta. Raymond James had their annual conference again. It was nice to be back in person, but still doing a lot of the digital content as well, which and Moody's has been wonderful. We've really enjoyed the in conversation webinars that we've been doing with a number of your speakers and yourself. Mortgages, autos, commercial loans, yourself on kind of economic, Mr. Durides on overall economic items, unsecured lending, credit cards. I mean, pretty much anything across the lending and banking sector is kind of what you and I have been doing over these last. It's 3-4 years now, Mark. It's not like it's been just yesterday. We've been at this for a while now. It's nice.
I know they're really easy, a lot of fun. And of course, you make them really interesting. And you have a really interesting set of clients. There tend to be smaller banks and credit unions, smaller financial institutions.
Yeah, the more regional and community guys are who we deal with, kind of that $75 billion in asset and down kind of institution. We love the Wells Fargos and the JP Morgans and the Goldmans of the world, but we're more the middle markets. So these regional banking crisis has been very real for us. This lack of liquidity that's out there has been very real, something we've been feeling for several months. So when you reached out and said, hey, this might be a timely topic.
Absolutely. This is
after Silicon Valley and Signature and everything. It was, we were in LA on March the 8th, right when that news came out. And it went through like wildfire. We had a conference in Beverly Hills. And I remember it was a Wednesday. And that Monday they were going concern. That Wednesday, they were talking about doing the capital raise. They had sold the bonds. And then by Friday, it was over. And it was like, whoa, what just happened there?
Middle of the day over, which is like
Yeah,
the FDIC never does that, right? They wait
and
till
didn't
the
have
end.
a buyer for it, right? I mean,
Yeah.
that was remarkable that we went through the weekend and who's going to buy the loans, who's going to buy the bonds, we don't know. So,
Which means they must have been really terrified by the deposit outflows that were occurring through the system for them to do that.
When you yell fire in the theater, Mark, and people
Yeah.
start running for the door and $42 billion starts running for the door, you don't have a whole lot of options.
Yeah, really amazing. And you're hailing from Memphis, Tennessee.
Memphis, Tennessee, and celebrating the Grizzlies win last night. I was in the forum. It was rocking as we took it to LeBron. And we're really just thrilled to get game 2 back. We lost Ja Morant. If you're a basketball fan, really gnarly fall on that wrist. He's got some soft tissue injuries there, but Xavier Tillman and Tyus took us to the victory. So now it's back to LA, and we're hopeful we can win one on the road and get the home court advantage back.
Well, of course, we're Sixers fans, John. So enough of the.
We'll see in the finals, my friend.
Yeah.
We'll see you in the finals.
Oh,
look forward.
Fingers crossed. I'd go for that.
Yeah. Look forward to seeing you there, and go Grizz. That's all I can say.
Yeah, I saw the game on Monday night. The Sixers play. Who did they beat? Who did they play? I can't even remember.
It's the East. I'm more worried about the West, but
the Brooklyn Nets. Yeah,
that's right. Yeah, you should handle.
I'm
that.
already looking past them.
You're 2-0 already. You've got game 3 tonight against the Nets. You're going to handle that easy.
Yeah, I hope so. I hope you're right.
Yeah.
And you're as we were saying, you're a lot of your clients are smaller financial institutions, obviously kind of ground zero for the problems in the banking system, and you do whole loan trading. Do you want to explain that just a little bit, because that's really critical to the conversation?
Yeah, so anything that's not in a bond that would be on the balance sheet, so the mortgages, the mortgage book, commercial real estate book, the auto book, credit card book, HELOCs, unsecured lending, solar lending, personal lending, people monitor and have been talking so much about the securities book lately and the unrealized losses and everything that goes with it. Bonds are 20% of the balance sheet. Loans are usually 60% of the balance sheet, if not more. And yes, we've had this kind of influx of cash. And so the securities book has kind of grown over the last 2-3 years because of COVID. All the stimulus that's been thrown at us, but the bond book, or excuse me, the loan book has its similar challenges to it. It's more illiquid. It's more difficult to trade. We're talking about raw collateral here. We're talking about the actual note mortgage on your home. We're talking about, the car you drive to work. We're talking about the office building that you're in right now. And pools of those loans as depositories manage that risk on their portfolio is kind of what we make a market and trade. So $50 million of prime jumbo residential mortgages, a bucket of a couple of pools of commercial real estate loans, maybe they're office, maybe they're retail, maybe they're multifamily, a pool of solar loans, particularly out in California, right? All of the solar panels that are kind of appearing on houses these days. There's a market for that future cash flow. I'll try to liken it to somebody who's familiar with the bond market and they're familiar with RMBS. Just chop the S off. It's the same cash flow. It's the same collateral. It doesn't have the full faith and credit of the United States government behind it.
Residential
it's just
mortgage-backed security, but not the security.
Take the security off.
Yeah, right.
Residential mortgage backed. So you're looking and buying the raw credit risk. You have to underwrite it. You have to understand the loan to value. You have to understand the borrower's position. Have to send them their credit and their income stream. But it's the same kind of underlying cash flow.
So this may be an unfair question, but I'm just so curious.
Sure.
If you take like a typical year, what would be like the annual trading volume for bonds?
Last year was anything, and last year was anything but typical for us. We did about $15 billion in loan sales, about 475 trades. Now, a bond trade's T+2, right? You settle in 2 days. A loan trade takes about 45 days to close. It's not unlike buying your house. So, you got a buyer and a seller. You got a contract. Documents have to be signed. diligence has to be done. It's a little bit more like an investment banking function than it is more of just a go to Bloomberg and enter in a QSIP and boom, you're done, or a stock order. So, volumes here in the last 2 years have been very elevated because there's so much cash in the system, and institutions were trying to put money to work and almost racing to put money to work as all these deposits come in and they're trying to spend it. Now, kind of the opposite is true. Trading volumes have really slowed down. Depositories are struggling for cash, almost even starting to try to hoard cash, and struggling with rising deposit costs, alternative funds of the bank term funding program, the discount window, brokered CDs, alternative forms of liquidity. So no question, trading volumes are down compared to what we saw in 22 and 21.
So here we are, mid-April. We're about a month past the SVB fail, the Silicon Valley Bank failure, and the banking crisis. I'm calling it a crisis for lack of a better term.
Fair. Yeah.
Probably. Given that the government had to step in and backstop everything, that feels like a crisis to me.
Two of the largest bank failures in the history of the United States, Mark. I think that qualifies.
Qualifies. Yeah. Okay.
Yeah.
So since that event or events, has trading volume really fallen off?
I mean, it was a little bit of hands off the wheel, and going back to March 8th, right? Kind of what we're talking about at the conference. It's more just like shock and awe, right? How could this happen? How could this happen so quickly? It was really kind of remarkable to watch. And there was a lot of phone calls coming in saying, hey, if I had to sell, kind of what could I sell and where could I sell it? But the problems persisted for a while. It's been pretty well documented. Rates have risen so quickly. I mean, you have the unrealized losses that you have in the bond portfolio. And one of the things I like to point out on SVB, it wasn't a credit issue. It was a liquidity issue, right? I mean, the bonds they had were underwater. Deposits flew out the door. They couldn't raise cash fast enough. They went to the Federal Home Loan Bank. They went to the discount window. It couldn't come together quick enough. By and large, I mean, they were mortgage backs and treasuries that were on the balance sheet, right? And it wasn't like it was the subprime crisis of 2008 all over again. We haven't felt credit at all be the issue. And that's pretty consistent with our customers and pretty consistent throughout. It's just when you double rates in a year, things are at discounts. And so there was that minute of everybody kind of racing around and looking around and saying, oh gosh, what if the spotlight hits me? And what do I do? And so a lot of phone calls were had with customers and a lot of conversations focusing around, hey, are these massive deposit outflows happening? Are there lines out the door with people, at the ATM trying to pull dollars out? And I remember sitting there that Monday morning after SVB crashed, and I looked around the room in my trading floor. I said, guys, did you go to your bank this weekend? Did you take out $10,000? Did you take out $5,000? Did you need some money under your mattress? Did you move money to Bank of America or Goldman or the too big to fail shops? And no, there were the handful of institutions on the West Coast that seemed to be, with the uninsured deposits, and that became kind of a story and a headline for a minute. But, largely it wasn't for those more, what I would call rural institutions that didn't have the word West in their name. It seemed like every bank that had the word West in it was under kind of scrutiny there for a minute.
And that's absolutely true. Banks had nothing to do with anything because they had West in it. In their name, they were getting nailed. Yeah.
It was almost like, a couple of years ago, if you had the word, Bitcoin or, something or .com way back in the day, you got nothing to go up now. If you have
exactly.
in it, because nothing goes down. But anyway, it seems to have subsided. It feels less volatile. It feels safer today. And we haven't had a closure in a couple of weeks now. I know there's a couple of names in the box that we're looking at. First Republic, Western Alliance had some good earnings numbers the other day. It feels like, Mark, we're almost to the other side of this. I'm hoping.
Yeah. And in terms of your trading activity, is that stable or is that coming back? Or
it's coming back? Yeah, no, it
Okay.
has felt more vibrant. There are, what we have experienced, for better or worse, loans, you don't have to mark to market. So let's put that out there, right? Whereas in bonds, you can do this held to maturity versus available for sale kind of game and gimmick and accounting. Loans, you don't have that experience. So most of these institutions still own these loan books at par, even though they're probably worth, 85 to 95 cents on the dollar today, not because of credit, purely because of, rate. And we haven't had a lot of people be forced sellers, no gun to the head saying, you need to go raise cash, you need to go raise cash right now. So we don't feel any of that urgency. But those institutions that were saying, I won't sell anything unless it's par or better, they've come off that a little bit. They've been willing to say, well, show me a bid at 97, show me a bid at 95 cents on the dollar, even though we're still a good ways away from that level. And that's because they do want to shore up some cash. They do want to be able to go to their regulator and say, hey, I've got a contingency plan for this. They're dusting that playbook off right now.
Well, let me ask you about the banking system, and I do want to get into different loan types and get your sense of what's going on.
Yeah,
get more granularity there, but more from a kind of a 30,000 foot level. Do you think the banking system broadly is in good shape, okay shape, or is what happened here more just idiosyncratic related to a few banks that are kind of out on the tail of the distribution that just got caught, and it's not symptomatic of something broader in the system? Or do you think the system is more troubled, and this is symptomatic of a broader set of issues?
No, I mean, I think the banking system is pretty sound. We have some issues.
Okay.
We have some liquidity problems right now, but it's not credit. So broad strokes, SVB was a little bit more of venture capital, some very wealthy individuals, a lot of deposits running out the door, a shareholder letter that spooked some people, and boom. We can even talk about maybe the mismanagement of how they did the attempt of the capital raise versus the bond sale. So there's that. Silvergate was more of a crypto story, and Signature, I almost felt like that was an afterthought. SVB happened on Friday, and then kind of New York said on Sunday, oh, by the way, we're going to close them too. Third largest bank failure in the country feels like an afterthought, kind of whoa. But most other institutions don't have that challenge. And we've talked about First Republic a little bit. They're a billionaires bank. So, okay, maybe that could happen, but it's been remarkable to me to see how the banking community has kind of rallied around that brand that is First Republic and has really tried to work very hard to save them. And it's a wonderful bank. But beyond that, everyday America Main Street lending doesn't have the run happening on them from a deposit standpoint. I don't think that others do. And yeah, there were some small deposit outflows, less than 2%. That seems to have stabilized a little bit. Yes, there was some kind of immediate hits to this new bank term funding program, the discount window, federal home loan advances, that's all happening, but that's subsided since the crisis. But by and large, credit is sound. Yes, deposit costs are going up. Yes, funding costs are going up. But they're well capitalized, and I think pretty good shape.
Hey, Cris, are you saying when as John is about is my interpretation of what John just said is, this is the SVB, Signature, Silvergate are kind of idiosyncratic. They've got their own specific issues. There may be a couple other 3, 4, 5 out there that might be problematic, but they're small, no big deal. I'm putting words in John's mouth. I added that.
Largely, I agree with you. Yeah.
Yeah. Okay.
Yeah.
And in the system broadly is on solid financial ground. What's your sense of that, Cris?
Yeah, I'd agree with that. I think we've largely dealt with the liquidity issues as well. At least there are facilities out there that if more problems should crop up related to that, I think we could muddle through. I've said it before, I'll say it again. I do worry about credit coming. I know there are no credit issues today, right? There are relatively few, but yep. I'm seeing into the future that we are going to get more losses, more delinquencies. I think there's lots of capital in the system today still that we could manage through. So I'm not anticipating crisis, but I wouldn't want to discount that there will be additional trouble ahead. There may be additional bank failures as we start to go through the actual credit cycle part of this.
Yeah. Marisa, anything to add there? Any pushback? Would you want to take the other side of this?
No, I agree. I agree. I mean,
it would be kind of scary to do that. Yes.
We're going under. No, I mean, and the Treasury and the Fed has, implicitly sort of backstopped all these deposits, right? So that really,
adds just, I think, to the confidence in the banking system if something else were to go awry. So that certainly helped.
Yeah.
I would echo what Chris said. He's right in that most of our customers are not worried about credit right now. Maybe on the bottom end of subprime auto, maybe on the bottom end of credit card, maybe on the bottom end of personal loans, unsecured personal loans. You're starting to see some signs of cracks there in credit. Mortgage, I think, is rock solid. I'm worried. Mark, you and I have talked about commercial real estate. We've talked about office in particular is really kind of not a place I want to be. But the upper end of credit, FICO, is sound. It's the lower end of income. It's younger borrowers that are getting hit a little bit more by inflation, struggling to kind of keep up with their payments. I've listened to many of your episodes here. I really enjoyed the conversation with Mike Brisson and the gentleman from
Yeah,
Cox.
he's good. He's really good.
I'm a huge Mike fan. He
Yeah.
does a great job and great command of his numbers too, right? I enjoyed
Don't
the
be
banter.
don't you're sucking up now, John.
I
don't
enjoyed
do
the
that.
banter between you two last week. It's always fun to watch you two kind of pass zingers at one another. But you know,
and the sad thing, he's a lot more right than I am. So
no. You know, it was great commentary. But you know, the auto sector has been an interesting space to kind of watch and kind of see how that's shaped up. I mean, I was looking for your numbers game last week, and if I had been on that panel last week for the auto conversation, it would have been my number would have been 17%, and that is the number of new vehicles whose payments are over $1,000 a month.
Oh,
So
interesting.
new auto loans and the value of those new auto loans have gone so high, coupled with higher rates. Imagine the average consumer floating a
Wow.
$1,000 a month.
That's really high.
auto payment.
I would
Carry
I would have
that
never
note
gotten
for a
that.
little
Yeah.
while, right?
Yeah.
That stings. And you know, Mike kind of danced
That's
around
like
it with
that used to be
used
the
values as
typical
well.
rental payment.
Yeah.
Right. Yeah.
Used to be.
So
Used to.
those are you know, those are challenges for that particular sector that could be coming, to Chris's comment. You know, if we do see unemployment tick up, which has been stubbornly low, and if we do start to see performance kind of spin out a little bit, he's right. There's some pain coming, but it's not here yet.
Yeah. Just to make it clear for the listener, because not everyone is kind of in this world as regular as we are.
It's very niche-y. Yes.
Yeah. Credit versus liquidity. Credit meaning
Thank you.
delinquency default. You know,
Thank you.
somebody's not repaying their loan. That's credit. And
Correct.
what we're observing here is that so far delinquency and defaults are low. They're rising, and concerns are going to rise a lot more, but right now they're low. Liquidity is about getting let's very simply, the cash that you need to make a loan and to operate. And of course, banks need continual funding, continual liquidity. And if that gets cut off for whatever reason, and of course, deposits are a key source of liquidity for banks, particularly smaller institutions, then that becomes quickly a problem for them. And it's existential, you know, very quickly. I mean, meaning they can literally fail, go out of business. So liquidity is John, as you've been saying, is the issue today.
Correct.
Credit may be the issue for down the road.
Can we latch onto that one? Because I've as I watch the talking heads on TV and the media as they post it, and they keep saying credit is tightening, credit is tightening. We don't feel that. We feel liquidity tightening. So these higher rates, deposit outflows, higher cost of funds. We've been at such a low interest rate environment, such a low cost of funds for depositories for so long, where it was literally a handful of basis points. You know, maybe your cost of funds was 50, 25 basis points over the last couple of years. Once you run out of those deposits and you have to go to the Federal Home Loan Bank, it's 4.5%, 5%, 450 basis points, 500 basis points as your cost of funds, or brokered CDs. It's expensive, right? And so as these institutions quickly realize, oh gosh, it's not cheap sources of funding, they have to raise rates. That's why we start talking about auto loans at 9.5%, mortgages at 6.5%, unsecured loans, credit cards in the high teens. Commercial real estate hasn't figured out where cap rates are yet. They're still really struggling right now for what's an appropriate loan rate. That's what I'm talking that our customers are really feeling right now is they're not pulling back because they're worried about credit. They're pulling back because they're worried they can't fund it. And that's going to be the part that'll be interesting to watch in earnings over time. So I take exception to someone who says it's credit that's causing them. I think it's cash and having to fund these loans. That's the challenge for them.
Or maybe just like the way we're thinking about it, it's the cash today, but it's also can these guys pay me back in the future, affecting
Sure.
my underwriting today.
Sure.
I was going to ask about the government response before we talk about the fallout of all this on the economy, underwriting, and on loan growth and on the economy. Obviously, the government backstopped the entire system, stepped in, insured all of the depositors in these failed institutions, those below the deposit insurance limit of $250K, those above. And then, of course, the Fed stepped in with a credit facility to help with that liquidity issue that we just talked about. What is your sense of that? Was that appropriate for them to do? I mean, there's a lot of debate, obviously, around that, because, the deposit insurance limits there because you want depositors with lots of cash in these banks to be very careful about where they put their money, to discipline the banks so that the banks don't take a lot of risk. And by insuring everybody, you're kind of creating this potential moral hazard. So that's the concern in the debate. Do you have a perspective on that? Where do you land? Where did you land on that?
So I live in a sales world, Mark. So in trading, we're always kind of
backstop me, please, baby. Don't
that's
no
it.
no
The hustle is
chances.
real over here, Mark. So I have incredible respect for the interim SVB CEO, who not 2 weeks after the implied or otherwise deposit guarantee was out there saying, we are the only bank in the country that has not the implied, the guarantee of the backstop. So please bring your money into SVB as we work to recapitalize this institution. That is selling 101. I loved that. I was really fired up to see this guy have the chutzpah to be able to just do this in this particular market. So is it implied? I mean, it's almost like what we talk about for the GSEs. Is it the implied guarantee of the United States and the taxpayer dollars compared to, look, most of us, my mother, she puts her money in her bank. She doesn't know what the bank is doing from an investment banking standpoint, from a wealth management standpoint, from a lending standpoint. All she wants to know is her money's safe. All she wants to know is she can still write checks. And yes, she still writes checks. That's still a thing for her, right? She's not using Venmo. She's not using PayPal. She's got a credit card, but she just wants to know when she goes to the branch. And yes,
John, just to interrupt, Chris is still writing checks. He writes checks to for his crypto accounts.
There you go. There you go.
Yeah.
Yeah. Well, I hope he's still got a balance there, right? Yeah.
Vintage Bitcoin.
But she just wants to know her money's safe, Mark, and she wants to know that she can get her money. And so at that very, very basic level, I do think that depositors should have that guarantee and should feel safe that their cash is there. And let's be honest, it is cash. It should be something that they can get out, and it should be something that's liquid. How about that?
Sounds fair. So let's talk a little bit about the fallout from all this. We're 4 weeks in, and everyone's trying to get a sense of, and the system is stabilized, obviously. The government backstop, deposit outflows have stopped. We're seeing less use of the various credit facilities. So it feels like it's moving in the right direction.
Yep.
But there is likely going to be a fallout. One of the principal links between what's happened to the banking system and the economy runs through underwriting. Will banks tighten up on their underwriting, make it more difficult to get a loan, or if you get a loan under higher interest rates, more onerous terms, and what that means for loan growth and credit growth, and ultimately that drives business decisions around hiring and investment, and consumer decisions around spending and economic activity. And maybe I'll go to Marisa first. To you, I don't know. Did you catch the minutes from the FOMC meeting yesterday? Did you have a chance to take a look at that?
I didn't know.
You didn't, Chris, did you take a look at that at all?
Yes,
Maybe I'm the
a
only
little
one who
bit.
took a
yeah.
look. A little bit.
Yep.
They spent obviously a lot of, this is the Beige Book. I should have mentioned the Beige Book that the Fed puts together. That wasn't from the FOMC minutes. I apologize. It was the
Oh,
Beige
okay.
Book that came out yesterday. Sorry
Okay,
about
I
that.
looked at both.
My
yeah.
bad. My bad. The Fed district banks provided an assessment of what's going on in their economies that they're in, and of course, this Beige Book was done after the banking crisis, and a lot of the focus was on underwriting standards. What are the banks doing with underwriting? Did you take a look at that, Chris? That Beige Book, and
I
you have
did.
a sense? Okay, hopefully I'm not taking your statistic.
I
or
know
anything
what
like that.
you're going to say. Yeah.
You are.
I already
I-
stole.
I-
I already
yeah.
stole two of his statistics.
I
you
saw
did.
what
The
you're going to
pre-call.
say.
Yes.
So
Pre-call.
he's
Yeah.
scrambling as it is.
So let me throw you out
So-
the statistic now. 9.
Yeah, what's your interpretation of that?
My
of the
number
Beige
is
Book?
9.
The number is 9. The number is
Number is 9.
What is the?
Oh, really? The number
'cause
is
it'll
9.
encapsulate the summary.
9 out of the regional Fed banks said that they were tightening,
Ooh,
or
Very
that they were
good.
seeing tighter lending standards in their districts.
No, that was more ambiguous. It was several said that they were tightening, seeing
Oh.
some tightening. San Francisco in particular, as you can imagine,
Makes sense.
is the most.
Yeah,
Nope.
they've got 2 of them on their hands right
Yeah,
now. So
exactly.
Yeah, I get that. Yeah.
But
Well,
what
is 9 that we put a number together to try to quantify the thrust of the Beige Book, because it's qualitative and we want to put a number on it. And so
Yeah.
we go in and we kind of distill the directionally what they're saying. And is 9 the number we came up with
No,
to describe that? No.
that's good.
Okay.
That's a good guess. But
Good guess. Okay.
you give
What
up.
is 9? Then what is 9?
So 9. So Marissa was close. It's 9 out of 12 districts reported little or no change in economic activity.
Oh,
Right. So
Oh,
if you're trying
okay.
to gauge what happened in the immediate aftermath, they're not really seeing
Nothing.
much of a. At
They're
least not
they're
yet.
not seeing an
right?
impact, or they're seeing a
not much of an
modest impact, except San
Modest.
Francisco. Yeah.
There were 3. Actually, San Francisco also was included in that 9 in terms of
Oh.
little or no change in
Okay.
economic activity. They're seeing more on the lending standards, some tightening. There were 3 districts that said that things are shaky, right? That the economic activity declined slightly. You want to guess those 3? Redeem yourself.
That's a really okay. This will be fun.
I know.
We each can say one. Go, Mercy. You want to go first?
New York.
Nope.
John.
I'll go with Marissa in New York.
No,
No, you already said no. That was wrong.
It's still no.
Still no.
I mean,
That's like
San Francisco would be my next. My next
no,
guess.
not
No.
that one. I'm going to go with Philly.
Yes, there you
No,
go.
I
Philly.
should have. That was a layup.
Yeah.
I should have known
Philly.
that. You with Mark. Yep.
Yeah, and there's 2 more.
How about Atlanta?
No, Atlanta's doing well.
Trying to pick the ones that are. It can't be Dallas. Dallas has
No,
got to be on
Dallas
fire
Can't
right
be
now.
Dallas.
Yeah, Dallas
No.
is doing great right now.
Richmond.
Richmond, very good.
Yeah.
Ah.
Okay.
All right.
See how you do this, John? This is how you do it. You
You got to
know,
wade
sit-
your way through it. Yeah.
Yeah. Yeah.
just
The
Pick
This last
things.
one will be impressive.
last one, yeah.
St.
I don't-
Louis.
Oh, Kansas City.
Yeah, I
Kansas
was going to go
City.
there. Yeah, because it's probably got a little
Alright.
bit more of the farm associated with it. Yep,
Kansas
that makes sense.
I'll have to say though, I don't spend a lot of time on the Beige Book generally,
No.
but I did
Yeah.
spend more time on this one because of getting a read on
timing.
the underwriting. And I was surprised, and banks are tightening their underwriting in response to what's going on, but I was surprised at how modest it felt like the
Yeah.
tightening was. It didn't feel like these guys are battening down the hatches.
No, that's what
That's
we're,
right.
that's
That's
Mark, that's what we're feeling on boots on the ground.
that
Customers are
right?
not worried about credit at all. We're still seeing risk on right now. They're again, funding they're worried about and finding enough yield they're worried about. They're worried about margin, right? I mean, they're worried about margin compression and that they know their funding costs are going up. We probably hit peak rates. I think that's true. And now they know that deposit cost, which is a lag. is going to start coming up, and they know margin is going to start getting pinched. And if Cris is right, and I tend to agree with him, that we're seeing loss provisions go up because charge-offs, probably going to, what I think a lot of economists have been saying, normalize, right? We're getting away from the stimulus and we're getting back towards kind of 2018 vintage as opposed to 20 and 21. So they're expecting higher losses, or more normal losses, I should say, and rising cost of funds, which is crimping margin.
So this seems to suggest like the key link between what is going on in the banking system and the real economy is not playing out as significantly as one might have feared just a couple, 3 weeks ago. Is that right, Cris? I mean, is that your sense of it? Yeah.
At least not yet. And I guess the other kind of key point out in the Beige Book that stood out to me is that tourism is reported as strong across the districts. So again,
yes,
the immediate consumer impact doesn't seem to be there. If people were really worried about, can I get money out of the bank, they would probably be more conservative in terms of that tourism. So,
which along those lines, Cris, on commercial real estate, that's one of the sectors that's kind of hot, leisure and hospitality. That's an area in CRE that's done well. It was also one that got hammered during COVID, right? I mean, Mark, when we had this conversation kind of early 2021 and lockdowns were pervasive, and you're also starting to see hirings and pretty strong, reasonable, better job growth in that sector compared to tech, banking.
There's also there's no new supply. We're not building any more hotels, or very few, right?
Yeah,
so compared to, we are building apartments, right?
We're not building office complexes, or if we are, we're struggling. That's real. Yeah.
So we were expecting the banking crisis to shave 3, 4, 5/10% off of real GDP growth in the coming year. The key link again is through tighter underwriting, less credit availability that impacts business investment, hiring, and consumer spending. But it's still way too early to think one thing or another. But so far, at least, it doesn't feel like it's going to come in any worse than that. The downside risks here seem less significant than they did a few weeks ago. That's my sense of it.
I think that's
fair. Okay.
Yeah. Barring some other
shock,
something else going on. Yeah. Right. Okay. I want to come back and kind of go through each of the lending types and talk about that. But before we do that, what's going on with each of those lending types? But before we do that, let's play the statistics game. And just to remind the listener, the game is that we each put up a statistic. The rest of the group tries to figure that out through questions, clues, deductive reasoning. The best statistic is one that's not so easy that we get it immediately, not so hard that we never get it. And if it's apropos to the conversation at hand or related to a recent release, all the better. And it is tradition on the podcast, John, to go to Marisa first. She's the first player in the statistics game. Marisa, you're up.
So the first statistic I picked, I really came out last week, but it's really good, and I kind of want to use it. So maybe I'll come back to it. Okay, but I'll play by the rules.
It's okay. It's fair.
Yeah, it's okay.
Fire away. If you really want to use it. Are you sure we didn't use it on the podcast? You listened.
Actually, no, but I kind of doubt that you did.
Okay, fair enough.
Okay.
All right, hang on.
Oh.
Okay, the statistic is 3.24% in March.
3.24%. Is it related to the CPI, Consumer Price Index?
No.
Okay. Was it a government statistic?
No.
Oh. It comes from a trade group?
No.
Oh my God. Is it a financial?
John might not.
Financial market measure?
It's adjacent. Yeah.
Is it an interest rate?
No.
Okay.
Is it commodity price?
No.
It's adjacent. Is it?
It's we're just talking about. It's related to some we're just talking about. John was just talking.
Is it loan related?
Yes.
Oh,
Delinquency,
it's not an interest rate on a loan. Okay.
delinquency or charge off rate?
Ah,
It is
must
a
be it.
delinquency
Yeah.
rate on,
Office
Mortgages.
delinquencies,
what was that, John?
office delinquencies.
Yes, it's the
Ah.
CMBS, it's the Moody's
Ah.
CMBS delinquency track, and that is the delinquency rate for offices. March, and out of all segments, right? So industrial, warehousing, hotels, multifamily, it's the only delinquency rate that is that rose last month, and it's been on the up and up for most of the past year, and it's now just about at its peak of where it was right in the middle of the pandemic. That said, it's still very low historically. I mean, it's
Historically, yeah.
3.24%.
Well,
You know, if you look at the whole
I
time
would
series,
take the
it's really
over
low.
going further. Yeah.
Yes, yes, it seems to be headed that way.
In-
So
in CMBS is
Commercial
commercial
mortgage-backed
mortgage-backed
securities.
securities. So
Yeah.
securitized commercial real estate mortgage loans. So
That's right.
office related mortgage loans securitized. That's the delinquency rate that
Yep.
is on that. Okay, as of March. Interesting. Is that? But you had another one, another statistic.
I
you
did,
wanna-
yeah.
Okay,
Sure,
fire
this
away.
is an easy one, and this one
Okay.
came out this last week. Is 2.9%.
And this came out last week. You said?
This
This
week,
week.
this week.
Oh, this
Yeah,
week.
yeah.
Nothing came out this week, as far as I can tell.
So this should be easy.
Yeah, that's true. That's true.
It should be
Uh,
easy, but I've been on the road this week and haven't been paying attention to my economic data. That's what's.
Is it a government statistic?
Yeah,
Oh, it is.
From the Philly Fed?
2.9%.
Chris, any ideas?
I said Philly Fed, but related.
yeah.
But
no, it's the Philly Fed.
it's not.
It's not the Philly Fed.
Not the Philly Fed.
What
What do we get? We got construction. I don't think it's.
Now
in
you guys
there.
are mining the data releases of the week.
well, we shouldn't be doing that.
Well, you're going to find it.
No. Yes.
Well, if I were to do a quick Google search, might it have been retail sales?
There you go, John. Yes, it is year over year
Ah.
retail sales in March. Yep.
Oh, year over year.
Yeah,
Oh,
year over year, they were
That's a
down 1% on the month. This is the third time in the past 4 months that retail sales have fallen on a monthly basis, and the growth on a year over year basis is now the weakest it's been since June of 2020.
yeah.
Implying the consumer is weakening a little bit, Marissa?
So I would say there are signs the consumer may be weakening a little bit now. And I should say this is headline sales. This includes autos and it includes gas, right? And we know that gas prices are down from where they were a year ago. But even if you strip out, sales are compared to where they were last year or so.
Yeah, of course, that goes back to Chris's observation about tourism, right? I mean, that also reflects a shifting in consumer preference, right? From
From goods to
goods
services. Yeah.
to services. So
Yeah.
hard to know. That's the hard thing about the consumer. So this big elephant, it depends on which part of the elephant you touch. You get this whole different perspective of what's going on. But that's an interesting one. But that was last week, Marissa. That wasn't this week, right? Wasn't that?
Wasn't it
last Fri-
Wasn't it Monday?
No, that's what that was a
No.
head fake. That was
Oh
really.
God.
that
All
was
right.
a-
I'm all messed
yeah.
up. I was traveling
Yeah.
at the beginning of the week too. I've been under
That
the
was last
I-
Friday.
I'm all
Fake
messed
news.
up.
Fake
Yeah.
news, fake news.
news,
Yeah, that's
yeah.
why I didn't get it, by the way, because
Yeah.
you know.
That's why.
That's
yeah.
the fake news.
That's the big news.
There's Chris over the
All
top.
right.
Thank you,
All
sir.
right, all right, John. You want to
Thanks.
go next? You want?
I would love to go next.
Yeah, fire away.
71.8 billion.
I know what that is. Should I tell you? Should I put you out of your misery immediately?
I mean, you're the one with the command of the math. Let's go.
The Bank Term Funding Program, BTP. Is it Bank Term Fund? BTFP. Yeah, you want to explain, John?
That's the new kind of liquidity facility post SVB that was released to give similar to what like the Federal Home Loan Bank would be or some of the other advances, but has no haircut. So if you're pledging assets and those assets are worth 80 cents on the dollar, you get the full 100% takeout as opposed to the haircut. And follow-up question, Mark. That number will be released today. So this is last week's number. Was that number up or down?
From the week before.
Correct.
Down, baby.
Down.
It was I'm speaking from memory.
Yeah.
79 billion.
That's
maybe?
on the screws. Well done.
Really?
2 for 2. You are, yes.
Okay, there you go. Yeah,
Which
obviously I'm following that very carefully.
I
Yeah.
would imagine we
Yeah.
all are in banking
Yeah.
land, right? But I think that also implies, some easing in the crisis that we've seen, is that we're not, rushing to some of those panic places. And there was some discussion around a lot of our bankers that when Q2 hit, as opposed to Q1 hitting, there would be a surge in that because they didn't want to report it in their Q1 numbers. They wanted to have it in their Q2 numbers as they kind of went over that April date. But I don't see that. I don't feel that right now as I stare at the information.
Yeah, I'm really a lot of good Fed data. I think does it come out tomorrow, John?
I think it's at the end of today. I think it's closed business today on Thursdays is what it's been doing. I think that's right.
Yeah, and then of course we get the Fed's H8 release, which is the balance sheet of the banking system, assets, liabilities. I think that comes out Friday, I believe, and that's for this past Wednesday. So that's another really good one. So that was a good statistic, but of course I'm looking at that like a lazer beam.
Oh well, you want me to give you a harder one? Can I give you a tough
one? Yeah. Feel
free. Which is near and dear to my heart. 81.4%.
Ooh. Is this a price?
From 70.2%.
Is it a price increase?
It is not.
Is it some kind of haircut on some kind of loan? No. Okay.
Sticking with the funding theme.
The funding theme.
Okay.
So oh, really? Is it Federal Home Loan Bank advances?
No, sir.
No.
It's a
By the way, John,
percentage.
just as a sidebar, I wrote a piece called "In Defense of the Federal Home Loan Banks." I highly recommend it. Chris takes great umbrage with it, but
well, I will side with Chris then, likely, in the conversation. But I will give it a read, and I look forward to our next discussion where we can take it apart.
It's well reasoned, though. Just
of course, naturally, always, yes.
Naturally.
Yes.
Okay, back to funding, 81.4%. What were you going to say, Marisa? You had something you were saying.
No. It's a percentage. It's not a
true.
Right.
Percent.
Okay.
It's a percent increase.
No. Well, it went from 70.2 to 81.4, and I'll give you one other clue. That's year over year.
Okay. So it went from 70 to 81. The year over year growth rate accelerated. Is that what you're saying?
Correct.
Yeah.
Well,
okay.
Accelerated is one way to look at it. Yes.
Oh, geez, man, this is.
Oh, wow.
Yeah.
And you said the harder the better. I gave you too easy of one in the first
Yeah,
time, so
yeah,
I'm going to give you a bit more of an obscure number for this
funding one.
This came out this week?
No, it's Q4's number.
Oh,
okay.
Q1's number has not been released yet.
Okay, so it's money market mutual fund growth. Nope. Okay, that goes to funding.
Is it a government statistic? Or
yes, I would think it's a government statistic. Yep. How about this? It's even more focused. It's a banking statistic.
Is it the federal senior loan officer survey?
Nope.
No. It's related to funding. So is it
Yes.
a bank liability?
Okay, you're getting closer.
So is it a deposit account?
There, we're getting closer.
Okay, so some deposit account has increased quite dramatically year over year through the fourth quarter
of 22 of 21 to
all
22,
deposits
correct?
are declining. So what could have been increasing? That's interesting.
Come on. You almost said it right there.
What, Chris, what would that be? It's got to be some money market. No, I said money market, so that can't be a money. No, it's a banking liability. CD, some kind of CD, small time. Oh, go ahead, Marisa.
Is it like loss provisions or something?
Nope. No. He's saying it's a liability, a bank liability. It's some funding source. It's a deposit
time
account.
Deposits, savings accounts, or
savings accounts. Not savings accounts.
Time deposits.
Small time.
It is the loan to share ratio for credit unions. Last year, they were what they call loan to deposit ratio, what credit unions call. So credit unions have gone from a 70% loan to share ratio to an 81.4% loan to rate. implying that those deposits have been flying up, that those loans have been lent, and they are running out of cash.
That was a really good one, actually, a really good one. That was because I couldn't think of any deposit account that actually went up. That I was barking up the wrong tree.
It increased, but it increased in a bad way, right?
Yeah. Okay, Chris, you're up.
Oh, I give you the 9, but if you want another one, I'll give you an easy one. Because I already we've gone through a bunch of.
Okay,
he's given us like 5.
Oh yeah, in fact,
He really
he's been washed out.
And don't forget the pre-call too. We
That's right.
knocked him out of a couple of them.
Yeah, we knocked him out. Okay, I got one, and this is, I'll have to admit, this has been a tough week, a really tough week.
It's a little thin.
A little thin. 940,000.
That's got to be the multifamily
Starts.
construction.
Wow. Wow.
Yeah. Well, John, it's not as impressive as it sounds, but yeah.
We
That's a
talk about this
go-to.
every month.
Smile on Chris's
Yeah.
face is pretty impressive right
Yeah,
now.
That's pretty good, Chris. So that 940,000, I'm rounding. I think it was a little higher than that. That's the number of multifamily units in the pipeline going to completion. Record number. Keeps on rising. Keeps on going up month after month.
That's
a lot of
worry you at
units.
all? Does that worry you at all? Is that a good thing?
Okay, it depends on your perspective.
Yeah.
If your perspective is inflation, I'd say bring it on, baby, because we need more rental units. We need declining rents because the rents are driving the cost of housing services. So that's my immediate take. Yeah.
So I'm going to take it from the lending side.
Yeah.
And we're talking about construction now, right? So we started building that particular multifamily unit, and the person who did that construction loan 18 months ago was in a very different interest rate environment and a very different cap rate environment than where he is today. And now that he's looking for permanent financing in a much more frightening world, how do you feel about the lending side of that particular piece of the conversation? And I would say the bid and the ask on that is Grand Canyon wide right now.
Yeah. I'm totally with you. If I'm a multifamily developer, I'm pretty nervous about this.
That's right.
If I'm a bank lender that's extended a mortgage loan into the multifamily space, I probably I should be a little nervous about this because it means higher vacancy, weak rents, and that might be create some difficulty. I also worry because of the tightening and underwriting for multifamily mortgage lending, which is clear from the senior loan officer survey and other anecdotes, that we may see some real pullback in multifamily construction. That'll take some time because you got all this stuff in the pipeline. But if you look out, towards the end of this year, and certainly by this time next year, I suspect we're going to see much less multifamily construction, which is not, we
Not a
need
good thing
as many
long-term.
housing units as we can
That's right.
possibly get, given the affordable shortage. So, in the immediate near term, trying to get inflation in, I'm saying I want lower rents because that translates into lower inflation, measured inflation. But
Shelter and housing, right?
So,
Well,
John,
It's not as bad though as the other CRE, right? You have Fannie and Freddie.
true.
Oh no,
Right.
multifamily is the good one in commercial real estate, right? I mean,
Right.
that's the poster child. And Mark, you and I have talked about this a long time. Chris, you and I have talked about this a long time. We had a housing crisis prior to COVID. We have a housing crisis post COVID. Builders were really the ones that got savaged back in the great financial crisis. We didn't build enough homes in the 2010s. We are struggling to kind of catch up. We need more housing, no question. It's just right now the financing that is going to be an interesting piece of the puzzle in the near term.
So John, you have a window into what's going on with all these different types of lending activities because of the trading and whole loans that you do. If you kind of rank order all the different types of lending, is office the thing you're most worried about? Would that be at the top? That's office mortgage
Office
lending?
and subprime auto and subprime card.
Okay.
We've wondered about this for a while. What happens to young people today and in this inflationary environment that we're in come July or August when we turn student loan payments back on?
Right.
$300 a month is the average student loan payment. We haven't been making that for 2+ years. Inflation has risen. We've seen the percentage of consumer debt coming out of the wallet of the consumer kind of continue to rise. Have those young people already spent that $300 elsewhere on foods and goods and car payments? And so when we turn that number back on and we have to kind of prioritize the payments at the consumer level, does that pinch cards even more? Does that pinch autos even more? Does that pinch mortgage? Again, looking at that kind of consumer number. So on the lower end of income, on the younger end of age, and on the lower end of credit, am I probably worried? In the consumer book, in the commercial book, I'm more worried about office. I'm a little worried about construction, kind of like what we just talked about with multifamily, but with other products as well. It's a similar conversation. We were in a very different interest rate environment 18 months ago. So those are the parts of the sector that we're in.
In going to the other end, which loan types are you most comfortable with and least concerned about?
Yeah, I mean, mortgage is I think in a great spot.
I see. Yeah.
We've got, how many of us have a 3% 30-year fixed rate loan? Or less. So what we call forever loans, it has been a real boom for the economy, and that 3% payment is exceedingly efficient. Almost too efficient, and it's not causing Americans to want to move, right? People are staying put because they don't want to lose their loan. And so what we've seen because of that is HELOCs really take off this year. Record volumes in HELOCs.
Home equity loans, yeah.
Home equity lines of credit, correct. Because you don't want to sell your house and you want to improve it. So there's kind of two schools of thought. I love my mortgage, but I hate my house. So I'm going to take out a HELOC to spruce up and make my house better. The other side of the argument is I love that house, but I want to date the rate. I want to go out and get a 6.5% cash out or a 6.5% purchase loan, and buy the home I want. But I'm really praying to God I have to refi in 2 years to get that payment down. So there's this kind of war going on in mortgage, but delinquencies are very low and have been very low. Maybe on the subprime part of credit, maybe the lower end of that, but mortgage has been so tight for so long. I think mortgage is in a really, really good spot.
Even with the house price declines that are kind of in train.
Well, you and I have chatted about this before. I mean, since COVID, home values are up 40%.
Yep.
So if I'm worried about those loans that were probably made, March of 22 and on, right before the Fed kind of put their foot on our throat and raised rates. So those are the ones, particularly those in the Zoom towns or those areas where people kind of bid up homes. Those are probably the ones. That's a pretty tiny window compared to the overall mortgage book that's out there. Because we really refied half of the $13 trillion mortgage market over the last 3 years. Quicken and United Wholesale almost put themselves out of business by refining every loan there is out there. So prepayment speeds on mortgages have been historically low, 3 and 4% CPRs, just because of people wanting to stay in the houses that they're already in.
Yeah. Marisa, I saw you put down your headset there. Were you going to say something? Do you have a different perspective than John on any of that, or is that pretty consistent with your views of credit quality across lending types?
Yeah, if we look at the data from Equifax that we get, we see the problem areas are subprime auto among younger borrowers and their consumer installment loans, but that's a very small share of total debt outstanding, right? So it's not enough to worry about in terms of a major economic impact if those continue to go. The delinquency rates on those two segments are now higher than they were in 2019 prior to the pandemic. Yeah. But, yeah. And mortgage is the best of the bunch for sure.
Chris, any pushback there? Seems like we're all kind of in the same place.
Yeah, no pushback. Marisa has this. Marisa has a.
Yeah.
What's that?
Which means we're wrong, probably.
That's right. We all got to go oppo now. We all got to say the world's about to crash down on its head and the consumer is about to completely hit
there
the wall.
There you go.
Yes,
we're all saying, they're all thinking the same thing.
Groupthink.
Yeah. But no, no pushback, Chris, or any granularity there? No.
No,
okay.
Marissa has this great chart for credit cards based on that data by vintage. And it's just shocking how bad the credit cards originated in 2021 and 2022 are behaving. The delinquency rates are well above any other previous vintage at this.
Which, I mean, that's a leading indicator, right, Chris?
Right.
I mean, that's a
Exactly.
part of the consumer that I think we've been kind of talking around that is worrisome.
Exactly. So I think there's plenty to worry about. But I would agree with the ordering. Resi, mortgage, we have lots of equity we'd have to destroy before defaults really picked up. So
Okay. Well, I think we're coming to time, but before we end, John, I'd like to kind of get you on the record, go back to where the conversation began, probability of recession. And I'm going to go around the horn here because we haven't done this in a bit. Let me ask it this way. And we've innovated on this question a little bit more recently. So, and you can answer this any way you want, obviously, but what a probability of recession would you put on a recession beginning at some point this year in 2023 in the remaining 8-9 months? And what probability would you put on recession conditional on no recession in 23 beginning in 2024? I know that's a mouthful, but you get what I'm saying?
I do, yeah.
Okay.
I think the probability of 23 is low. I'll say 40%.
Okay.
I think the probability of a soft recession is in 24. And it really kind of, you and I have talked about this a lot. I think we got one more rate hike coming. I think it's May. I do think we're higher for longer. I think Powell's serious about keeping it here and killing inflation. I think he knows that if the banking sector cracks, he can always drop rates if he has to. If he has to choose between the banking sector and inflation right now, he's picking inflation. And I think he's been just razor clear on that. Even though the market is desperate for a pivot, he's not giving it to us.
Mm-hmm.
So I think we get another quarter-point hike. I think we're higher for longer. I think inflation's a little stickier than we want it to be. So it goes down, but it doesn't go down as much as we hope. And I don't have a firm number on that. I'm a trader. I'm not an economist, but that's kind of the feel for me. So I think a low probability of a recession this year, but likely one in the early part of 24.
So over 50% in 2024.
That's fair.
Yeah. Because inflation is stickier and the Fed may need to raise rates even more later in the year, something like that.
God, I hope not. But
okay.
Yes.
Yeah.
Every time Powell gets up on stage, I just want to grab the shepherd's hook and just pull him off and just say, please stop.
Well, that's his intent though, John, right?
Oh, he's been consistent.
He wants you to be pessimistic. He wants you to be upset. He's got you in his sights, you know.
I'm mad. Mark.
Guys like you.
He's
getting what he wants.
Victory.
He's winning. Yes. For sure.
Okay. Good. Very good. My views are very similar to yours, but I'll come back to that in a second. So Marissa, what are your probabilities now?
I'm at 45% for 2023 and about 55% for next year.
Okay. Very good. And same kind of logic as John articulated? Yeah.
I mean, barring some, it's always unforeseen, right? Seems like it is. Barring some unforeseen shock this year, the economy seems very, very solid. We seem to have gone through this banking crisis fine. So I don't see a recession this year. I think the bigger risk is beginning of next year when rates have been high for a significant period of time and things have been flowing for a while.
Although I find it so fascinating that you characterize 45% as low. It's like, it feels like pretty damn high to me.
Well, I mean, if we do have a recession, though, this will be the most pontificated and forecasted recession in the history of ever, right?
Absolutely.
I mean, we have been talking about the inversion in the yield curve for how long? And that, if we miss on this, we have good company. Love that.
Yeah.
And how many people predicted or said we were in recession or would be in 2022, right? I mean, if you go back then, there were so many people that thought a recession would happen last year.
Well, Mark, we were in a technical recession for a minute there. You and I had that conversation.
Mark bristles that.
I'm not going there.
Technical. That's why I said it with,
wait for the revisions.
all reverence when I made that statement. I knew I'd get the grin that I'm looking at.
How in the world do you create 500,000 jobs a month and call it anything close to a recession. I don't know.
You don't.
I don't know. Yeah. Right. Anyway, Chris, where are you on these probabilities?
Unchanged, 45% this year.
Yep.
So consistent with Marisa, 65% chance. Conditional on no recession this year, 65% chance.
That's a change, Chris. That's a change. You're at 67%.
Oh,
Yeah.
No,
I'm-
well,
oh
Yeah,
yeah,
he
yeah,
was
yeah, yeah. You're
2
down.
weeks ago,
glass
he
half
was.
full kind of guy, right? Yeah.
so 67% was the full 18 months, right?
Oh,
The
oh,
or,
okay.
right?
Okay,
Oh,
fair enough.
You narrowed
So
the
if you're
window.
so
is what it was.
John's or right
Yeah.
recession either this year or next year is 70%, right?
Okay. Got it. Got it. Got it. Yeah.
Which I
got it.
think is yours too, Mark.
It is. It is. Yeah.
So that's above the 2/3 threshold. Right?
I've used your slow session terminology a few times in my conversations, Mark, where
actually, that's Chris's. I don't want to take
my
credit
apologies,
where credit.
Chris. There
He
it
actually
is.
is paying for the
We're a
URL.
team here. We're a
Yeah.
team.
we have the TM on that. I mean, what do we got? We got
We've tried, or I think we got denied, or I don't know.
you know, red
Did we
tape.
get denied,
It's
Chris?
not
I
worth
don't.
it.
Not worth it. Okay.
Yeah.
Yeah. Okay. That's very helpful. I lied. I have one more question, and you may not
Please.
know the answer to. You may not have an answer to it, but I ask everyone this question because I'm confused by it. So if you look at you mentioned the Treasury yield curve being inverted, that's screaming recession, right? But if you look at the corporate bond market and look at spreads, they're the difference between corporate bond yields and Treasury yields, risk-free Treasury yields, is very, I wouldn't say narrow. It isn't small, but it isn't wide. It's kind of near historical norms. No sign of recession there. And then if you look at the equity market, the stock market, clearly it fell a lot in early 2022. In my view, that's just a reflection of a normalization of rates rising. The Fed starting to raise rates and normalize rates. Price earnings multiples came in, but over the past year, pretty much now, I think it's been a year since stock prices have basically gone sideways. They've not gone up, they've not gone down. The S&P 500 is still sitting at, I think, 4,100, 4,150, kind of at the top end of the range of the past year. That's not saying recession. So, and of course, I should have said the corporate bond market's not saying recession. So, do you have a theory as to how to square those things? Do you have any sense of that?
Well, so the 2-year right now, 416 as I stare at the screens, the 10-year at 353. So we're 62 apart on 2s and 10s, and that's come down quite a bit. We were at around 100 there for a hot minute. You and I will disagree on this particular topic, but I think the market just kind of factors in there's going to be a bailout, right? Every time we don't let things fail anymore. I mean, we'll throw money at it. We just threw $5 trillion at COVID. If there is a challenge in a product, we just guaranteed deposits. I think we're banking on the bailout.
That is interesting. I hadn't heard that one. So you're saying maybe we go into recession, but ultimately policymakers step in and say, we're not allowed.
Or the Fed will cut. I mean, that goes, I think
cut.
if he has to choose right now, he's choosing to fight inflation. But if we have something that truly is systematic, he always has in his back pocket that he can eliminate unrealized losses by cutting rates.
Right.
And that would, and we got a pivot indirectly whenever SVB happened and the 2 and the 10-year plummeted. I mean, the 2-year was over 5%. It's, only back up to 417. The 10-year was what, 4.5%, 4.25, I think is where it kind of peaked out at. And, now here we are back at 353. So, I mean, and those drops have eliminated or at least reduced some of those unrealized losses in the banking sector. So I worry about that long term. Is just throwing money at it is always, it's been our solution for the last several crises.
Of course, it was with this banking crisis as well, right? We didn't tolerate any pain. Yeah. Interesting. That's a great, interesting take. Yeah. Very interesting take. Okay. Well, that was I really appreciate it, John. Thanks for coming on. We learned a lot. I learned a lot. And I really appreciate you taking the time. Anything I missed? Anything I should have asked you that I didn't ask you?
No, I mean,
other than will the Grizzlies win the NBA championship? I didn't ask you that, but
we can go in. I mean, I'm hopeful and prayerful. Jaws okay. I think if he's back, we've got a chance. I hate that we lost Brandon Clark, and and Steven Adams. We got the injury bug kind of nipping us, but hey, look, if it's the Sixers and the Grizz, you and I are attending that game. We're going to make that happen. Right?
You're on. You're on.
Let's go.
Yeah, you're on.
You know, one, just thank you, Mark. We've had a great relationship over these last couple of years, and I've really appreciated everything Moody's has done. The partnership with Raymond James and Moody's has been fantastic. Chris, you've been fantastic in our calls. Marissa, great to meet you. You know,
Nice to meet you finally.
haven't interacted in the past, but I've enjoyed the conversations. It's been great to do this and everything else that we've had going on for these last several years.
Right back at you, John. Really appreciate the friendship
Yeah.
and the relationship with Raymond James. So thank you very much. And with that, dear listener, we're going to call this a podcast. Take care now.